This is one where I know I've said it a few times, but having a good proactive accountant and or a good proactive advisor can go a long way.
Yeah, it is a quagmire. Do not do this alone.
Welcome to the Physician Sense Podcast, a podcast designed specifically for physicians, offering a breakdown of complex financial topics to help you develop your financial IQ, further your financial journey, and improve your well-being. Whether you're a medical student, resident, fellow, or attending physician, you're sure to learn something new that will benefit your journey. And now, your hosts, Chad Chubb and Tyler Olson.
Welcome to another episode of the Physician Sense Podcast. I am your co-host, Chad Chubb, with the one, the only, a fantastic sweater for the chilly time in the Northeast, Tyler the Olson. I'm going to start adding the in there more often. I like it. I think it has a nice ring to it.
Good to see you, man.
Good to see you.
It is currently 56 in my office.
Oh,
yeah. Well,
in your workspace. Oh my Atlanta! Well, now I see why you like to wear sweaters. You're like at a casino. Well, your brain's flying right now.
I mean, I've got a space heater. My office is in my attic.
I know that.
So it's not fully like finished, like in a way where it's like I've got a heater up here. So I got the space heater here. But sometimes the cool, it keeps me more like, all right, like I got to get some stuff done. But like this sweater, this is like an old like Marshall Fields wool sweater. I wear this out in the forest doing work with a hat on in 25 degrees and it's fine. So like this in 56, like I'm good to go. I don't know.
Is the space heater on?
No.
Oh.
No, because I don't want it on right now. Like I'm like if I turn it on, then it's gonna get into the mid 60s and I'll be too warm.
Take your sweater off mid-episode.
Yeah, exactly.
All right. Well, another hot topic. We are back for more taxes, my friend.
Let's do it.
We are on part 2 of the 3-part series. Most common tax mistakes we see from physicians. Again, from Tyler's beautiful thread on November 2nd, 25, 43,000 views, over 200 likes, 500 bookmarks. Last episode, which was episode 48, we covered 1 through 5. Today, we're going to start at 6, and we're just going to see where we end because we have been known to chat it up a little bit. Are you ready, my friend?
I'm ready to rock. Let's do it. What's number 6?
Number 6, making direct Roth IRA contributions when ineligible. If your income is too high or you file separately, you're disqualified. That triggers a 6% annual penalty until you fix it. 3 lines with some heavy hitters in there. Well done, my friend.
Oh, thank you. So this would be more relevant to those for 2 segments of the physician's space. One would be people who are transitioning from training to attendinghood, and they don't realize they think they're doing something great in January, February of the year in which they're finishing training. They make a direct Roth IRA contribution. They get a $50,000 bonus in September. They're suddenly making a lot more money, and their income between the last, January through June, trainee income, bonus income, plus new attending pay bumps them above the direct Roth IRA contribution income limits. And now they have to backtrack. And that really stinks because especially if you made some money, now you're going to have to pay taxes on those earnings in order to get them correctly into the Roth IRA via the backdoor method. So if you're coming upon like your completion of training, don't just make direct Roth IRA contributions. You may want to by default do a backdoor Roth contribution. There is like one limited issue with doing that, like the 5-year rule we could talk about. But otherwise, it's a better idea to probably by default in the year that you finish training to do the Roth IRA contributions via the back door. The other segment is people who are still very well in training and they're like, well, I don't meet the income thresholds. I'm making $60,000 a year, but you end up filing your taxes separately from your spouse. For those of you who are married, you can't make direct Roth IRA contributions if you file your taxes separately. You make more than $10,000 in a given year, and you are living with your spouse at least 50% of the time. There's some caveats to this because sometimes, one person is living in another part of the country and the other person's living there. If that's the case, then this is a moot point. But there's some specific rules you got to watch out for if you file your taxes separately and you want to make Roth IRA contributions.
Yeah, those are the two demographics where we see it most often too. Just to add on your note, if you were even close to the income limits, just do the backdoor Roth. The only downside to that is what Tyler kind of hinted at is there's technically two separate 5-year rules inside of Roths. If you go directly to the Roth and you don't do the backdoor Roth, you can get access to those contributions without any extra weight, right? That's kind of one of the unique parts about Roths. But if you do it as a backdoor Roth, it wasn't a direct contribution, it was a conversion that triggers a new 5-year wait. For most of you, that should be a moot point because ideally you're not ever tapping into your Roth this early in the game. Yes, I get it. Life happens. So I'm not going to say never, but ideally you're not. So that's the one downside if you do end up doing the Roth conversion, but you were below the limits. But again, ideally for most of you, that's a moot point. But yeah, if you're doing married filing separately or you're in that transition year out of training into attendinghood, this is one you got to keep an eye on. Especially if you did everything right. You did the set it and forget it. You're doing, a couple $100 per month to the old Roth IRA and life's busy. You forget about it. And before you know it, you're playing, ideally you're playing fix it as soon as possible. But sometimes it sneaks by, a little bit longer than you'd even expected. So fantastic tip here for number 6. Again, one for the physician community in particular because of those high income limits, or high income numbers, I should say, that we're keeping an eye on this.
Thing to note, I think that 6% annual penalty, that does not come into play until you file your taxes. Did you mention that?
I did not.
So like if you're mid-year, like say, like as any of you who are listening to this, it's like middle of the spring. If you made this contribution in January, you're not like, oh man, I'm already getting charged 6%. That hasn't happened yet. So just rest assured that you need to contact the platform that you used. Like the most common one we see with, that I run into is Fidelity. And they have a very simple recharacterization form. And they'll help you. Like they'll even estimate what the recharacterization numbers need to be. You can tell them, yeah, you tell me how much I need to recharacterize back to a traditional IRA and then redo the backdoor Roth. It's fairly simple, but you just have to take care of it in a timely way.
Yeah, good point. Yeah, it's a couple, I think it's a 2-page document for Fidelity. It's very simple. If for whatever reason you were about to switch custodians, so say you were about to switch from a Fidelity to a Vanguard, try to get this cleaned up before you switch custodians.
Oh, yeah.
At the custodian that you did it, it's a simple 2-page document. That easy. When you switch custodians, the other custodian is going to tell you that they're not going to calculate anything for you, and you have to do it manually. So for whatever reason, if you're just one of the people that are listening and you were about to switch from a Vanguard to a Fidelity or a Fidelity to Vanguard or Schwab, whatever, just fix this all at the custodian where you made the contribution. Much easier. Thank me later.
Yeah, no, great point. Great point. All right, what's next? Number 7.
Lucky number 7. Forgetting to coordinate retirement accounts. 2 401ks, 1 total limit. In 2025, we listed 23,500. That's also, what did we go up to for 26?
24,500.
That's what it is. We got 1,000. Yep. So when you're listening to this, that's now 24,500. Many overcontribute by mistake and owe taxes or at least a hassle on the excess. You can tell that you work with physicians, my friend.
Yeah. No, I mean, this goes again to like in our last episode, we talked about the doctor that gets money from the medical school and from the doctors, the physicians group. And they both offer 401ks or 403b. Like this is where people get tripped up is they think they can contribute to a 403b and a 401k and that those contribution limits are not cumulative. They are. But see, what's confusing is that there are some retirement plan types that are not cumulative, and we can enumerate those briefly. But if you got a 403b through one employer and a 401k through another employer, the cumulative contribution limit for an employee on the employee side, if you're under age 50, is $24,500 for the 2026 calendar year. So it doesn't matter if one's a 403b and one's a 401k. You can't personally, from an employee standpoint, contribute beyond the $24,500. The employer matching contribution does not apply to this. Employer profit sharing does not apply to this. So this is just what you personally as the employee put in on a pre-tax or a Roth basis.
I was just going to say to what you said earlier, right? One of the ones that we love to see is the 457B. So that is one that truly sits on its own island. So you can have a 401k or 403B and still max out a 457B. That's the beauty of the 457B. As we always say at WealthKeel, we always just call it sits on its own separate island. For those of you with 1099 income, this also applies to your solo K. We have seen accountants butcher this one, where they think it gets a whole new employee bucket to that solo K. That is not the case. If you max out your 401k, 403b at the hospital, and you have separate 1099 income and a solo K, you don't get to put in that $24,500 to your solo K as well. You already maxed it out. But what you do get to do is that profit sharing contribution. So that's why the solo K is still very powerful. So it's the over contribution, but it's also coordinating everything together so that you're getting the most bang for your buck. You know, for most physicians at your current tax rates, we're trying to get as much pre-tax as we can. And then eventually we'll have chances to get some over to Roth down the line with Roth conversions much later down the line. We're talking like financial independence, retirement type stuff. So yes, don't over contribute, but two, make sure that you are filling up all the buckets that you are allowed to fill up, my friend. That's the important one here.
Yeah. Amen. Question for you.
Yeah.
401A.
I was just that's so funny. Man, we are built for each other, my friend. I was just thinking 401A in my head.
Getting specific guidance on that. And like, I mean, the 401A, it's also its own island, but there's a lot of confusion about it because it just doesn't get a lot of attention. And even the publicly available IRS information that is digestible, not like the tax code itself, but like their explanation pages. It's not super clear, but yeah, the 401A, you can contribute to that and the 401k.
Again, I think that's a very important topic for the physician community because the most common place, at least in my 15 years, to see a 401A is it at an academic hospital where they're saying, hey, you have to put in 5% and we'll give you 5%. So what Tyler is saying with that 401A, if your employer requires you to put into that 401A, that requirement number does not affect your other $24,500 to a 403B. So just keep an eye on that because I've said this before at presentations that like in a perfect world, you get a 401A, you get a 403B, and you get a 457B. In that example, you could be cranking away on your own dollars, not bringing anything in from the employer side. You could be cranking away some serious money as a high income physician if you have that setup, which again, most commonly for myself, we'll see that at some of the academic hospitals more than I don't think I've ever actually seen it in a private sector. Does that match up to your thinking and your thought process?
Yeah, no, that tracks. It's something that needs to be evaluated for sure to make sure that like you have to know for sure from the plan documents that the plan is what they're saying that it is, like on their website, like and on the employer handbook information. Because sometimes they're wrong. Like they like whoever has written either the handbook or updated the website, and they're saying, yeah, you can contribute to this account. This is the name of the account. But then you ask for the plan document. And I've seen where they say that it's a 401A, but it's not. It's actually a 401k. And then you're in trouble, because now it is a 401k. It's not separate. So you got to look at the plan documents. So, but I mean, yeah, at academic institutions is where I see the 401as. And, in private practice, it's more like 401k and maybe a cash balance plan. But, that tracks.
Yeah. The one document that we always try to look for it's called the summary plan description or the SPD. Right. Again, even just asking HR outright, sometimes this can even be overly complicated for HR. So don't take it from the advice you got in the cafeteria. Don't take it even just straight from HR, which I would assume that they're going to be on a good path, but actually confirm with the documents. Again, I know I keep saying this, but a proactive financial advisor, or even a proactive accountant, can kind of confirm these things and make sure that all the buckets do align.
Mm-hmm. Yeah, absolutely.
All right, that's a good one for number 7. All right, number 8, another good one here. Number 8 is ignoring cash balance or defined benefit plans. They can shelter over $100,000 per year for high earners. Most stocks have never heard of them. They're not appropriate for everyone, so consider carefully. But if it's right for you, it's an awesome tool. Preach. I agree.
Oh, yeah. And this can apply in both private practice and in, again, the academic community in terms of pensions, because a defined benefit plan is, another word for that is pension. And there are some institutions that offer pensions. Now, in the academic world, the pension is usually something that you don't contribute to. Sometimes it is, but usually it's something that the employer contributes to, and it really gains some steam, some momentum if you are there for a long time. And then it can create retirement income for you really robustly. And that's an example of a defined benefit plan. If you're in an academic institution, you want to look at that, but you want to take it with a grain of salt, because like it for you to benefit from it in the way that would actually matter, you have to be there for like 20, 25 years. Now, in the private practice world, cash balance plan is the pension version that they can sometimes offer, but that has to be a very specific setup, because cash balance plans, they can be useful for small practices, but the ages of the employees really matters. And if you've got some young partners and you've got some older admin or other sort of like assistants, it doesn't work well, because the actuaries, they have to apply the benefits in a way that supports people as they get closer to retirement. So if you have non-partners that are older than the partners, that may not work. Whereas if the partners are older and like the staff is few and younger, then it can work really well. So if you're an owner, you may want to look into this. Or if you're joining a practice and they have a cash balance plan already, that's the sweet spot where you're like, oh, they already qualify. I want to take advantage of that. You got to look into that.
Yeah. Yeah. Cash balance plans, I think of them more in terms of like private side, or even, great 1099 income. They cost a couple $1,000 to run every year. You're going to have an actuary run the numbers. So it kind of goes back to our S Corp conversation. If you have $20,000 of 1099 income, it might not be worth the cost of admission to go set up a cash balance plan yet. That number higher clearly gets a lot more attractive. This is another one where the state also has a big impact, right? California, we probably have more solo Ks in the state of California than we do any other state, only because not only are we avoiding federal taxes, we're also avoiding very high state taxes. So that can also be a big win if you're in those higher tax states. California is, again, just the first one that comes to mind. But usually you're going to find someone that's very good at cash balance plans. For example, WealthKeel, we don't set up our own cash balance plans. We team up with another third-party provider that, all they do is cash balance plans. And then we'll kind of overlay that and build that into their plan. Similar to what we would do for a 401k plan. So it's not, a cash balance plan isn't something that you're just like, oh yes, here's a DocuSign for Fidelity. We'll open this up for you. And, wham, bam. There's a lot of moving parts to these. But, as Tyler noted in the tweet, 100,000, depending on the age numbers, you can get 150, 200,000. You can crank away some serious numbers into these cash balance plans. So
you mentioned 1099 income earning docs, like those on their own. What kind of income levels have you seen where that can be useful?
I would still be, I'd almost go back to like our 250 number that we said for S Corps. Like you want to be a little bit higher. We also will sometimes have conversations with our clients. If they have a good amount of 1099 income, we'll actually have conversations like mega backdoor Roth versus cash balance plan. Do you want to do more after tax stuff, or do you want to do more pre-tax stuff? And then we'll kind of choose there on, do we just want to do a solo K, but then load up on the after tax to do a mega backdoor Roth? Or do you want to start doing this? Sometimes we'll layer both of them together, kind of depending on what. Clearly, the numbers are important here. But yeah, it's, again, you have to have some good money there. It depends. Each person's different. You want to run through the numbers. Like, if you're in the state of California, the numbers might be attractive even lower because we're also avoiding the state taxes as well. So it depends, but I'd say your 200, 250 is probably where we start kicking the tires. Under 100,000, I don't think we're even really looking at it. Maybe 100 to 200, you're maybe at least kicking some tires, but maybe not putting anything in motion yet.
I think it's a matter of income, but it's also a matter of longevity, because for it to work, it's something that you need to foresee, that not just income level, but that income source type, the 1099, to be consistent at least 7 years, at least. So if you're someone who is, I rub shoulders with a lot of EM docs who come out training and they're like cranking out $400,000 and they're like, oh, should I do a cash balance plan? And I say, maybe. How are you doing with your workload? And they're like, oh, well, I could do this for a few more years, but I really would like to pull back. And that makes sense. But if we're going to run the numbers on 400,000, we have to make sure that that's what you're going to continue doing. Otherwise, we need to do it at what the more sustainable level would be. And of course, the higher the income, the more viable it is. I've got a few physicians in high income tax states who are making over $1 million in like self-employment income. And aside from S Corp strategy stuff, we're also like, we implement cash balance plans. And like this past year, a couple of them, they were able to put away like $240,000, something in there. And man, that really makes a difference. So, but it depends, as we say.
Yeah. Yeah. And the other thing that most people, I'm sure your clients say the same thing, that are absolutely shocked with cash balance plans, you are going to invest in something very boring. You're likely going to invest in something that's yielding like 4-5%. And don't get mad. That's all done with the purpose of you being able to put more into the plan. Because if you get crazy growth in there, you're not going to be able to put as much in the plan. This is why we need an actuary every year to run the numbers. Mm-hmm. But literally, one of our largest cash balance plans, the last 2 years in a row, we had to move to cash pretty much right before Q4 to essentially keep things level so that they can make a larger contribution, because they're not as concerned about the growth as they are about the tax savings right now. They know that eventually when the plan's done, they can move it over, we can get more aggressive with it. But that is one that we always like, wait, what? Why are we investing in a bond ladder? Like it's the number one question always comes up. So if you are going in this route and you're working with an advisor and they're telling you that you're going to be in something very boring, that's all normal. That's all calculated risk. Anything else on cash balance plan?
No, I think we're good.
Love a good cash balance plan. All right. Number 9, investing without tax awareness. High turnover mutual funds and bonds in taxable accounts equal unnecessary tax drag. Asset location matters.
Yeah. So docs, as they build up their investment plan, and they say like, okay, I've got my 401k maxed out. I maxed out my HSA and I'm investing that money and my backdoor Roth. And now the next is the taxable account. And having tax efficient investments is an important consideration. We like even recently had a couple of clients who they brought in like a bunch of money that came from an inheritance, and that is all taxable, like it's in a taxable account. And so in order to make the allocation work, looking at all their investments across the board, there's a very heavy position that's in the taxable account now that wasn't there before. And so what we're doing is we are reorienting the 401k and 403b plans to be more bond heavy, because on a percentage basis across the whole big picture, it's not as large as the taxable account. And so, but we don't want to put bonds in the taxable account because bond income, especially if it's not qualified, it's going to be taxed at their income tax rate, which is high, and that is inefficient. So that's what we're talking about. So what we try to get the bonds into the tax deferred pre-tax accounts, since they are protected from that income, at least while the money is in those accounts.
Yeah. To your first point, the high turnover mutual funds, I'd like to think, and I'll give a shout out to Dr. Dolly here. I'd like to think White Coat Investor and the White Coat Investor Nation has done a good job pushing why indexed ETFs and indexed mutual funds should be preferred. So I'm going to throw it out there that I hope you're not having high turnover funds, whether those are ETFs or mutual funds. I know they're still out there, but it's getting better. We still see moments where you're like, wow, that's I can't believe that's still in a portfolio.
Mm-hmm.
And to your point on bonds, for high income physicians, high income earners in general, also be very aware of something called municipal bonds. Whenever we build taxable accounts, we are big fans of municipal bonds. You still want to have bond diversification. You don't just want to put everything into munis, but municipal bonds are exempt from federal taxes. So if you're going to build out a taxable account, especially, as that position grows, the taxable account doesn't have any limits. So what we usually see from our physicians that are, 40, 45, 55, the taxable account is their largest number. So you're being very specific on what you're putting in there from a tax perspective. So check out municipal bonds. Again, you're probably still going to have some taxable bonds in there just for tax diversification. Bonds are another spot where, while we like the idea of a lot of index and passive, there's some pretty good research out there that shows a little bit more active style in the bond management, especially in an interest rate environment where we don't know what's next, which is where we are currently. It's worth the cost of admission to maybe pay a little bit more for a more actively managed bond fund, whether that's through an SMA, whether that's just a little bit more actively managed mutual fund or ETF. Not saying you have to do that, for everything, but if you're listening to this and these are new terms, I would at least do some more research on that. But at the end of the day, you're trying to keep that taxable account as tax efficient as possible. There's many ways to do that, but Tyler's two notes there are definitely two ways to keep an eye on it for sure.
Yeah, this is where the effective investment and tax planning are real needle movers. Invest in this.
And again, I'm also, it's like, maybe it's just a financial planner to me. It bothers me when you have a new client join you and you can see that the tax conversation never was discussed with whether we call it the investment side of it or the tax side of it. We just had a 7-figure client join us, a lot of taxable assets, not one penny in municipals, not one. And we can show them their tax return and say, like, see this line here that says tax exempt interest? We can move stuff from this line to this line and you're not paying, 37% on it. But it's, again, if you have an advisor or an investment manager that's not paying attention to that whole picture, they're not thinking of that. Where, you and I think the same way. Like, it's that net return that's the most important once we're done with all these steps here. All right. Feeling good there? All right. 10. A little student loan love here. Married filing separately for student loans, then forgetting to switch back. That one change can cost you thousands in lost deductions and credits each year. This one's pretty straightforward, but we see it a lot.
This is a TurboTax problem, or the like, because usually if you're working with a qualified and competent accountant, they're not going to just by default say like, well, this person, they filed married separately last year, so obviously they want to do that again this year, because that would be idiotic. However, with software, when people do things themselves, a lot of times the software will pull from what you did last year, and they'll say, hey, you did this last year. We've already done all the work for you. All you have to do is input your numbers. Now, sometimes they take you through some questions to ascertain, like, oh yeah, how should you file? So maybe there are some improvements, but usually when I've seen this problem come up and a couple, they're like, oh yeah, well, we filed our taxes separately. Like, and I'm like, well, why? And I look and it's like, well, they used TurboTax or something. And it was just like the default. It was like, this is what you did before, so let's do it again. And when you file separately, you're now subject to a different set of tax brackets versus filing jointly. And you're also, you lose out on certain tax credits, depending on your income, like, kids and things like that. So, but it's just something that needs to be intentional. Like, how am I going to file my taxes? You got to look and see and make a decision that's right for you.
Yeah. I won't add too much to it. One thing that we always like to do is ask the accountant there's a sheet in there that's pretty much, I think it's literally called married filing separately versus married filing jointly worksheet. And it'll just show you the tax bill between the two. And usually married filing separately is going to have a higher tax bill, but then your goal is to compare that to what you're saving in the student loan world on your student loan payments on your IDR, your income driven repayment plan, and then decide how to move forward. So keep an eye on that year after year, especially as student loans continue to be this, revolving door of what's next. But comparing those on an annual basis, whether that's again with a proactive accountant or a proactive financial advisor, that is another good way just to kind of keep an eye on things. But clearly, if you're comparing the numbers, you also know, should you not even be using that this year? Should you be doing married filing jointly and that type of conversation? But, nothing in your finance or tax picture should be set it and forget it. Maybe besides like your automated savings. That's the one where ideally you do set it and forget it. And it's a nice high number. But these types of things, you got to keep an eye on.
Yeah, definitely.
All right. 11. This is an important one. Number 11, missing out on the QBI deduction. 1099 docs or S Corp owners can deduct up to 20% of income, but many phase out or set up their entities wrong and miss out entirely. Good old QBI.
So the QBI deduction, this is more of like a in the weeds one. It's also known as Section 199A, and it's available for owners of pass-through businesses, sole proprietors, partnerships, LLCs, and S Corps. And you can deduct up to 20% of qualified business income from that taxable income. So you can, it's relegated to specified service trades or businesses. I mention that is because there are thresholds that if you pass them, then you're no longer eligible for it. And so the limits, let's see, I think for 2020, I had this written down here.
Are you looking for the income limits?
Yeah.
Yeah.
You got it?
Yeah. Married filing. I just typed this one in. Married filing jointly, 403,500. And then the full phase out, that's where it starts. The full phase out is by 553,500.
So doctors that have that are owners, or they're like in the 1099 world and almost exclusively. So we're not talking about W-2 employee docs here, unless you have both and your 1099 income is fairly high. You need to pay attention to how high your income is, because if you have this income and it starts ratcheting up toward these thresholds and it passes them and you become ineligible, then of course you're missing out on that. And now, ironically, S Corp strategy and QBI, they are kind of in competition with each other when it comes to strategy. So that might behoove you as your income gets close to these thresholds. Obviously, more income is not bad, but you do want to, if you've been benefiting from QBI, then you're used to that impact on your tax bill. And then all of a sudden your income goes up just a little bit, passes the threshold, you don't qualify anymore, and all of a sudden that 20% deduction is gone. You're going to feel that really hard. So if you're self-employed and you're growing your practice and your income is going up, you're like, oh, this is great. I'm and it feels good, but you need to recognize that there's going to come a point where all of a sudden this crutch that you've had is going to disappear. And you can try to offset it if you're just kind of over the threshold a little bit with any additional retirement plan contribution opportunities. This is where cash balance plan can often come into play, where if you haven't had it before, but now your income is going to be getting into the $400,000 and $500,000 range and higher, that you might want to consider it, because it could give you the chance to then get that taxable income below the threshold again, while putting away a good chunk of change toward retirement. So it's really important for docs to pay attention to this if they're close to or above these phase outs.
Yeah. Yeah, I think you said that wonderfully. Outside of getting super nerdy on QBI stuff, I think we're going to keep it high level there. This is one where I know I've said it a few times, but having a good proactive accountant and or a good proactive advisor can go a long way. As Tyler noted, once you get through that threshold, it can be painful, especially when you're talking about the size of those numbers, right? $500,000, 20%, just call it 100,000, right? These are pretty large deductions that can kind of just fall out. So just keep an eye on that. There are ways to work that down, as Tyler noted as well, but QBI is important. So if you are one that's taking advantage of QBI, pay attention to those limits as well. All right, we'll get to 12 here, and then we'll be able to save the last few for our part 3 of the series. But I feel like we can end on this one to be a good one here. So number 12, forgetting about state taxes. Multiple states equals multiple filings. Locums across borders can get tricky if you don't plan. Another really good topic here.
The solution here in most cases is to be working with a qualified tax accountant. If you're in a situation where you're working across borders, it gets very tricky because it certainly is about making sure that you're not running into penalties or interest payments because you didn't pay taxes to a state that you owe taxes to. But sometimes if you do it incorrectly and you with one employer, you filled out a W-4, but because you live in another state, the reciprocity rules make it so that you don't actually have to pay state income tax to that state. You pay it in your state because you live where you are, or the opposite. But then because someone in HR made an error, you end up paying taxes to a state that you weren't supposed to. Getting money back from a state in this situation is such a pain. It is so annoying. I hate it. So if you're in a situation where you're going to be working cross-border, or if you're going to be working in multiple states, you got to get an accountant before this. You have to, in my opinion, because trying to do it yourself with TurboTax or whatever, it does not know what to do with it, and it really messes it up a lot of time.
Yeah, no, I agree. I mean, heck, one state alone is enough, but let alone multiple states. Not only that, I mean, you get into not every state has local taxes, but we're from Pennsylvania. I always make the note, right? Philadelphia has higher local taxes than the actual state tax, so you kind of get into these different situations. We don't see it as much in the physician space, actually, usually with the physician spouses, but also if you change states and you had a national company, don't forget to update your address on file, because that's another one where we've seen clients have lived in state A and they moved to state B. They forgot to update their address with their payroll provider. They're still withholding taxes for state A. Now they haven't paid anything to state B. So now they have to catch up and pay state B while they still have to wait, as Tyler just noted, right? It takes a while to get the money back from that state that you essentially overpaid. You'll get it back, but it's going to take a while because you have to go through the whole process. So just kind of a unique, weird one, not as common in the physician space because you don't see like national-based physician organizations all that often. But usually we see that for the physician spouses quite a bit. Just one of those weird things to keep an eye on.
Yeah, it is a quagmire. Do not do this alone.
I mean, taxes in general, it's one of those ones where I'm outsource it. Yes, you're going to pay a few bucks for it, but outsource it. Let a professional jump in there. If they make a mistake, they have insurances in place for you. Your time is very valuable as a physician. Whether it's a physician, a parent, a spouse, your time is valuable. So outsource this. Get a big file together. Send it to the accountant. I don't want to say forget it after that. I mean, you clearly want to know what's going on, but we're 12 steps in, and there's been numerous times where we said, one mishap there, it becomes a big problem. So we'll stop there, my friend. We caught up. We were down by 1. We're now tied going into the third period here.
Yes. All right. Awesome. Yeah, I love these topics. So, and we'll round it up 13 through 18 next time.
All right. I will catch you on the next one, my friend. Stay toasty. I'll talk to you in a bit.
Sounds good. See ya.
This information is for general purposes only. This information is not intended to be a substitute for specific professional financial or tax advice, as individual concerns vary. Please see a financial professional, CPA, and/or an attorney in regards to your own individual situation. Wealth Heals advisory services and financial planning offered through Vicus Capital Inc., a federally registered investment advisor. Olson Consulting LLC, offering advisory services and financial planning, is a state registered investment advisor.